Dear student, hope you all are safe and sound by the grace of Allah. I am Asam Rupa, lecturer of Accounting, Department of Accounting, Islamia College, Chattogram. Today's class, BBA Professional, first semester, Basic Accounting. Today I am going to discuss about inventory. What is inventory? I am giving a short description. Inventory is an asset. Inventory is a current asset. In broad sense, the term inventory means an exhaustive list of assets, goods that a company holds from the stage of purchase till the stage they are sold off. According to Accounting Standard 2 Revised, inventories are assets held for sale in the ordinary course of business. In the process of production for such sale, or in the form of materials or supplies to be consumed in production process or in the rendering of service. Inventories cover the goods purchased and held for resale. For example, merchandise purchased by a retailer and held for resale, computer software held for resale, land and other property held for resale. Inventories also include finished goods produced or work in process being produced by the enterprises and include materials, maintenance, supplier consumables, and lost tools waiting to be used in the production process. Inventories vary according to the nature of the business. According to trading concern, inventories under this type encompass products purchased for resale in the existing form, and inventory of supplies such as wrapping paper, curtains, and stationery. According to manufacturing concern, inventories under this type consist of raw materials, working process, and finished products. According to Accounting Standard 10, accounting for fixed asset machinery spares is not included in the inventory and are to be treated as per Accounting Standard 10. If inventory is not properly measured, expenses and revenues cannot be properly matched and a company could make poor business decisions. Importance of inventory valuation from different angles is necessary to assure accurate financial statements. An inventory valuation allows a company to provide a monetary value for items that make up their inventory. Inventories are usually the largest current account assets of a business, and proper measurement of them is necessary. Methods of issuing inventories. There are two methods of taking inventories: periodic inventory system, perpetual inventory method. Periodic inventory method. Under this method, value of inventory is ascertained by physical counting and checking of all items of inventory at the year end, and the same is verified from the book entry. This system may take a longer period of time while ascertaining the value of inventory. Time taken depends upon size, nature, and volume of business. In some cases, routine business transactions have to be suspended for the time being. This method provides for the recording of purchase, sales, return inwards, and return outward in a chronological order. It does not provide for continuous inventory or daily balance of inventories at hand. At the end of each accounting period, physical counting is done and the valuation is made using inventory pricing methods such as LIFO, FIFO, average, standard, etc. Perpetual inventory method. This method involves continuous recording of addition to or reduction in material, work in process, and finished goods on a day-to-day basis. In other words, it shows inventory balances after every receipt and issue or sell to facilitate regular checking and to avoid suspension of operation for stock taking. This way it provides a running record of all types of inventories at hand. This method enables management to resort to random checking and verification of physical inventories with the recorded one to ascertain discrepancy if any. This ensures an effective control over inventories. However, one should not get confused with the term perpetual inventory and continuous stock taking. Perpetual inventory method refers to system recording, whereas continuous stock taking means physical checking of those records with actual inventory at hand on any day during the year. Inventory costing method. Inventory includes the raw materials, work in process, and finished goods that a company has on hand for its own production process or for resale to customers. Inventory is considered an asset, so the accountant must consistently use a valid method for assigning cost to inventory in order to record it as an asset. The valuation of inventory is not a minor issue, because the accounting method used to create a valuation has a direct bearing on the amount of expense charged to the cost of goods sold in an accounting period, and therefore on the amount of income earned. The basic formula for determining the cost of goods sold in an accounting period is beginning inventory plus purchases minus ending inventory equal to cost of goods sold. Thus, the cost of goods sold is largely based on the cost assigned to ending inventory, which brings us back to the accounting method used to do so. There are several possible inventory costing methods, which are number 1, first in first out method, number 2, last in first out method, number 3, base stock method, number 4, average cost method. Average cost method. We can divide average cost method into two ways: simple average cost method, weighted average cost method. Number 5, standard cost method. Number 6, specific identification cost method. Number 7, replacement cost or net realizable value method. Number 8, lower of cost or market price. Number 9, retail inventory method. First in first out method. This method follows the rule that goods, materials purchased, produced first are issued, sold first in a chronological order. Thus, issues or sales are made in the order in which materials, goods purchased or produced. However, it is not necessary that cash flow pattern should coincide with actual materials or goods flow pattern. FIFO does not mean that oldest materials or goods are necessarily issued sold first. It simply means that oldest costs are used for accounting purpose irrespective of actual materials, goods in flow. This leaves the inventories to be valued at cost, which most closely represent the current cost. FIFO method is suitable where inventory turnover is very high or prices are falling in the market and the material inventory is not a major factor in the current assets but constitute a very small percentage thereof. Last in first out method. This method is based on the assumption that items purchased produced last are to be issued sold first. Thus, closing inventories are valued at the cost of earlier purchase. LIFO method does not mean that materials or goods purchased produced in the last are always first to be issued or sold. It simply means that the price of last materials Purses are used irrespective of actual material or goods in flow.